Now next, let's see. How do we actually draw supply and demand zones on the chart using candlesticks? Method number 1. The range zone. This one is simple and powerful. You draw your zone based on the entire candle range, from wick to wick, right before price breaks out with a strong, aggressive move. This gives you a broader zone, which can reduce your chances of missing the trade. But keep in mind, it also means a wider stop loss and possibly a lower risk-to-reward ratio. Method number 2. The pivot zone. This is more refined and offers greater precision. Here, you look for a pivot candle, the last bearish candle before a bullish rally for a demand zone, or the last bullish candle before a bearish drop for a supply zone. You draw your zone from that candle, or include one more if it fits better based on your style. It gives you a tighter stop loss, often with a higher reward to risk. You may miss more entries if price doesn't come all the way back. So, which one is better? Neither. It all depends on your personality and risk tolerance. Some traders prefer precision. Others want to catch more setups. There's no right or wrong, just consistency. What really matters is this: stick to one method, master it, and build your edge with discipline. The third method for drawing supply and demand zones is the fractal model. This method zooms in on how price behaves within candles, and it's divided into 3 powerful types. Type 1, inside bar candle zones. This one shows up during strong expansion moves, where price is aggressively pushing, but suddenly stalls. You'll spot a candle that doesn't break the high or low of the previous candle. That's your inside bar, and what it's actually showing you is a range or consolidation on the lower time frame. Type 2. Wick zones. Now this one's sneaky, and smart money loves using it. In a bullish rally, you might see nothing but big green momentum candles. No visible demand zone, right? But look at those wicks. They're not just noise, they're lower time frame pullbacks. Those wick zones represent hidden sell-to-buy ranges, where price briefly dipped to grab liquidity before pushing higher. The same thing applies in bearish moves. Large candles with long upper wicks often hide buy-to-sell zones on the lower time frame. Type 3. Wick-only optimization. This one's for traders who want maximum precision. Sometimes a pivot zone is just too large. The full candle might give you a massive zone that's hard to manage. Here's the fix. Just use the wick. That long wick often is the real footprint, the actual reaction zone from the lower time frame. By focusing only on the wick, instead of the whole candle, you're narrowing down your entry zone without losing accuracy. Not all zones are created equal. Now obviously, not every supply or demand zone you see on the chart deserves your attention, because some zones just don't hold. They get broken, ignored, or barely respected by price. That's why we don't just mark every little pause in price as a zone. We only care about the ones with real weight behind them, the ones smart money actually respects. And to find those, we need clear, mechanical rules. So before you start marking every base or breakout as a supply or demand zone, let's break down the exact rules that separate the fake-out zones that actually move the market. Rule number 1, only focus on zones that break structure. This is the easiest and by far the most powerful filter you can apply. Here's the logic. If a supply or demand zone caused a clear break of structure or a market structure shift, that zone is statistically more likely to hold. Why? Because structure breaks usually means strong momentum, and momentum means institutional money is involved. So instead of guessing, let the structure tell you what matters. Rule number 2, look for strong moves away from the zone. The bigger and cleaner the move away from the zone, the stronger the imbalance. You want large, impulsive candles with little to no overlap. Here's one of the most important signs that a supply or demand zone actually matters: the strength of the expansion move. When price shoots away from a zone with clean, impulsive candles and minimal overlap, that's not just random price action. It's a clear sign of a strong imbalance between buyers and sellers. This kind of movement tells us that smart money placed a heavy order at that level. And when institutions are involved, you better believe price is more likely to respect that zone on the way back. As you can see in the examples, the strongest supply zone is the one followed by the cleanest and most aggressive bearish move. The weaker the expansion, the weaker the zone. So always ask yourself, how strong was the reaction? Because the strength of the move reveals the strength of the zone. Rule number 3. Time spent equals strength revealed. Want to know how aggressive the smart money was at a level? Just look at how long price stayed there. When price barely pauses at a zone before launching out of it, that's your clue. It means a strong imbalance. It means heavy institutional orders hit the market fast. The logic is simple. The less time price spends inside a supply or demand zone, the more out of balance that level is. And that kind of imbalance usually comes from smart money stepping in with serious volume. So when you see price tap a zone and explode out, that's not hesitation. That's precision. That's institutional activity. And that zone is way more likely to hold when price returns. Rule number 4. Freshness. Every time price comes back to a supply or demand zone, it's not just tapping it, it's draining it. Each mitigation reduces the remaining orders in that zone, weakening its strength and making it less likely to hold in the future. That's why fresh zones, the ones that haven't been retested, tend to give the strongest reactions. The more times price returns, the weaker that zone becomes. So avoid zones that have been tapped multiple times. They've already served their purpose. Stick to fresh, untouched zones if you want high probability reactions. Number 5. Look for liquidity sweeps. Now this one's a game changer, and one of the clearest signs of smart money activity. The most powerful supply and demand zones often form right after liquidity is swept, because those zones are created by institutional moves. Institutions can't just jump into the market blindly. They need opposing liquidity to get filled without heavy slippage. If they want to buy, they need a pool of sell orders. And if they want to sell, they need buyers lined up. Let's say they want to go long, they need sellers. So what do? Here, the market sweeps sell-side liquidity right below these equal lows. That's where early buyers have their stop losses stacked, and breakout traders have their sell stops waiting to get triggered. Smart money knows this. They intentionally push price below these lows to trigger those orders, and then use that surge of supply to fill their long positions. That's why when price returns to that zone, institutions often defend it fiercely. Because that's where they entered before. The zone becomes a strong demand area, likely to trigger the next big move. So remember, zones formed immediately after a liquidity sweep are some of the highest probability supply or demand zones you'll ever find. That's it, traders. Thanks for watching. I hope you found this video useful. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics.